How's it going, guys? This is Forensic Forex with Deontay, and I'm back with another video. This is your daily update on crude oil. As you can see here on Tuesday, we do get a down close. Price does not take out a previous daily high or previous daily low, so we got an inside bar. Now, I learned that the inside bar, normally after days like this, it might be suggested that you shouldn't trade unless you have outright confidence and you're taking that risk, and your rolling probability is your odds that price will continue going higher. Generally, after days like this, you want to see if price breaks the range high of this candle or the range low of this candle, and that will continue to show you where the market is likely to trend because we're inside this candle's high and inside this candle's low. Overall, though, we do get a swing low confirmation. We talked about that in the previous episode. We said that within this region of this fair value gap, we would get a higher swing low. So price is still showing bullish momentum because we're breaking swing highs and we're creating higher swing lows. Though we had that raid last week, that sell side raid, price still continued to trend higher. So after this down candle, and it's also a small down candle, and I normally tell traders that when you are on a bullish trend and you get a down candle like this, you can have yourself a counter trend candle. So buying after down days can be really probable for you, especially going into a certain day. So we're going into a Wednesday. So this candle just opened a couple hours ago. We can see that going into this daily candle, we could probably look to be long and look for a large dynamic range to come into play because the market has gone small, which makes the public eye uninterested. So psychologically, retail traders, when they see small candles, they are less interested in the asset class. But when they see large candles, that's when word gets around town like, oh, gold is moving super fast, or oil is moving super fast, or dollars moving super fast because of those large candles. By that time, everybody gets the news that the market is moving very fast. All that excitement dissipates. And then that next day, everybody tries to participate, and it seems to have just gone, and the party has left. And that's what happens here with these candles. So it's large, small. Everybody probably looked to go long on oil the next day because they weren't able to capitalize this, or they brought at the very high here before this pullback, and then here they're getting stopped because they're probably full margin, or some scenarios where they're probably just psychologically unsure now because they thought price is going to continue to rally strong after getting this large move up. Instead, we do get a hard pullback for the day. So that can definitely stir up retail traders' psychology. When we get days like this, if you're not already in the market, when you get a day like this, especially if you get a large day, you don't want to look to trade the next day. If you do trade the next day, you got to risk small. That's what I would tell traders. But after a large day, suspect that a small range cycle is going to come back into play. And that's when everybody's normally going to get trapped. Everybody's going to lose their sentiment and be confused about where the market's going. And then the following day, you continue with that overall bias of being long. Here, you can put back on your standard risk, whether that's 1%, 2% for your day trade, or if you're a position trader, maybe even, 75% of whatever you normally would risk, you would take there. So a lazy trader approach to this, or a swing trader approach, or a day trader could also utilize this as well. Almost any trader, you would want to buy at the open and at the close, and you'll be using a buy stop and a buy limit. So this Wednesday candle just opened not too long ago, a couple hours ago. It's still Tuesday, but the candle's open, you can see. And right here at the close, we want to be using a buy stop order. So price is coming down. Correction, we're going to be using a buy limit order. Always say things backward. A buy limit order. So price comes down and knocks you in bullish, or a bias that's bullish to the upside on weakness. So price is coming down, knock you in long on weakness. And then price with the buy stop is knock you in long on a bullish bias with a movement of strength up. So you're buying on strength and you're buying on weakness. So that's how you utilize this down candle here. Now that's just something I learned through ICT's free YouTube stuff. And it's a very good way to get into the market. If you don't have time to place a day trade or stay up for London, or be able to trade because you got a job during the New York session or whatever the case may be, you could set your parameters the day before it even starts, because it's not midnight yet. It's currently still it's 6:51 here, 6:51 p.m. in New York. So you could set this up to look to go long. Your risk really small and look to hold for higher prices. All in all, we don't see any swing lows being broken. The swing lows are normally what I call bearish momentum. And in order to get that continuation, we get a lower swing high and a lower swing low in that formation. We've only been getting higher swing highs and higher swing lows. So that's why my stance is simply bullish on oil until we really break structure to the downside with a swing low broken and price not returning to break a swing high like this. So price sweeps a swing low, but it returns back to a swing high. That's that scenario. If it was going to break this swing low and continue going lower, it should have done this instead. So let's just show it out with a line. So it comes up, makes a swing low, and it breaks that swing low. It should come back up and then continue to sell off, but it doesn't do that. So that's why we were able to stick to that bullish bias here that we have on the daily. Now you can do the same thing on the weekly, but here on the daily, I like to read the day by day price action so that you guys have concise understanding of how you can simply read the market, when to avoid trading, what to speculate, and how to put more probabilities on your odds. So Wednesday is an ideal trading day, right? The bulk of the volume comes in midweek. So generally Tuesdays, Wednesdays, and Thursdays, there's a lot of volume. Even sometimes Mondays, but generally on average, Tuesdays, Wednesdays, and Thursdays are the ideal trading days. The fact that we're getting this lineup together, right? Multiple confluences, a small range candle that's down going into a Wednesday, we could be looking for a large dynamic candle to unfold now. So hopefully this was insightful. Peace.